All right, let's jump into it. The Fed met yesterday, so I want to unpack that entire meeting, talk about what is happening in the housing market, the mortgage market, the U.S. economy. So, Mr. Frost, welcome back.
What's up?
What's up? So, unpack the CPI report. Let's get right into it. Let's talk about that first, the impact it had on mortgage rates, and then we'll get into the Fed meeting.
Yeah, for sure. So the CPI report, that's like one of the, as far as exactly what it is for those that don't know, right, is a consumer price index. So there's two different versions of this report that we look at. We look at the consumer price index overall as a measure of inflation, and then we look at what's called the core CPI. And the reason that we do that, and the reason that it's looked at that way from an economic perspective, is because the core CPI number strips out the price of food and fuel, right? Because those are, you can't control crop cycles, you can't control the price of oil and things like that. So that number, though, is what we really look at. Like, what is that year over year decrease? Because now what we're looking for from an economic perspective, and what is the Fed going to do? We're looking for what was inflation doing last year compared to this year, and what's that change? As in, are we corralling inflation and bringing it down, or is inflation still out of control? Because that's the big fear, right? So CPI came in this week, and so our inflation year over year dropped from 7.7% to 7.1%. So you're looking at a 0.6% drop. And the overall November inflation increased by 0.1%, and the economic gurus were expecting 0.2%. So overall, and this goes back to what we predicted, that these numbers are coming down. Like, what the Fed is doing is working.
Absolutely.
And when you look at, again, year over year on that core CPI number, and you strip those things out, inflation went from 6.3% to 6%. So we're making a lot of headway in that inflation market, which was really, really welcomed in the interest rate world.
Yeah, well said. And that's the thing that people that don't understand really, I guess, what they're talking about when they keep saying that mortgage interest rates are going up, they just have no finger on the pulse of what is actually happening that is impacting mortgage interest rates. Because you can't say mortgage interest rates are going up while inflation is going down. It's a statistical improbability. And that's why as soon as I hear somebody say mortgage rates are going up while core inflation and CPI numbers are coming down, I'm like, well, you just don't know what you're talking about. Because like we've always said, mortgage rates follow inflation. Go ahead. You want to?
Yeah, it's a market thing, right? I mean, it's a money thing is what controls these. It's investors that watch rates of return in certain things, and they move money back and forth in these vehicles. So it's not even like we're going to make rates lower because inflation is being corralled or because the government's doing something. This is all the guys that make money with money that do this.
That's right.
And they don't miss, and it's not exciting. Like, this is boring stuff. I mean, for most people in our world, we think it's awesome, but it is, like you said, as inflation comes down, it does not make sense for interest rates to not come down with it. That's just how those two measures work.
And here's the unfortunate thing that we'll get into more later in this video, but it's kind of weird because this is the part that I think people confuses most, is that when we talk about things under the context of them being good news, that context is specifically around mortgage rates and the housing market, but it's not good news for the vast majority of the people in the United States. It's not great for the economy, because what's happening, high level economics 101, is when the Fed says to the world, and I want people to understand this, Steve, when the Fed raises rates, it's damaging the economy. When the economy is in pain, mortgage rates get better. You see, those are the correlations I want people to draw from to see, okay, while you're speaking in terms of it being good news, when it is, in fact, for the vast majority, it's tough news, because it's damage. It's really demand destruction, right? So they keep raising interest rates to damage the economy. But you and I understand the damaging of the economy helps the mortgage market. It helps
Right.
mortgage interest rates go down because as the economy gets worse and as we most likely head into a recession, which we'll talk about later as well, always, and what will also happen is that mortgage rates, as a reflection of us being in a recession, as a reflection of the economy being worse, mortgage rates will go lower. Your thoughts on all of that?
Yeah. I agree with 100%. It's tough love, right? So they're
Yeah.
raising rates and they're fixing the economy the hard way. None of the
Yeah.
way we want to do things. So there's two things to keep in mind. So inflation is 7.1%, right? So that means the price of things are going up 7.1% a year. Like that's a highly manipulated number. I mean, if you look at the price of anything, it's 7%. And I said this a long time ago. I think we were going back and forth about the price of chicken. All right, because I ate like 12 pounds of chicken a week.
Yeah.
But like, if it was only 7%, it wouldn't be that bad. And something to keep in mind, and this is like an old school finance rule, but it's called the rule of 72. And it's if something grows at 7%, it will double in 10 years. So think about that just for some of like the main street items, right? If you buy that's saying if inflation, if we don't go through this tough love now and go through this pain, that your $50,000 Dodge Town or Chrysler Town and Country minivan, right, is $100,000 car 10 years from now.
Yeah,
Which is like hard to fathom if you think about that price growth. So that's why they have to be hard on inflation right now.
Yeah, it's just a short-term pain, right, to fix things. So, all right, here's how I want to kind of transition. So I'd like to maybe just unpack Powell's summary points when he opened up the meeting. And I have, I don't know, maybe 5 or 6 of those and whatever ones you want to add. And then I want to talk about the open Q&A and some of the questions that Jerome Powell was asked after the press conference that I thought were really interesting. So to get into it, the Fed raised rates by 50 basis points. We didn't know if it was going to be, 75 basis points, but they came out, they ended up being 50 basis points. So staying on that for a second, now that they have communicated that, what impact did the raise in the Fed's fund rate have on mortgage rates over the past 2 days?
Really nothing, right? So rates were driven by, and this is so important for people to remember, like we're going to talk about, they said in the press conference, but that press conference is what drives the markets and how these things get priced in because there's experts out there that they know exactly what the Fed's going to do, and then the Fed strategically leaks it. But interest rates really changed. So we went down, like we were talking last week. We're the rates are vacillating right now, right? Between six, let's call it 6.5 and 5.875. It's a huge range.
Yeah.
Depending on which way the wind blows that day, rates are up a quarter, they're down a quarter. So we're up around 6 3/8 or 6.375, right, on your standard 30-year loan. And after the CPI report came out, we dropped down to just under 6%. So we're trading in that just under 6% range again. Fed came out, they raised rates 0.5%. Interest rates went way down for like 1 minute, and then they went right back, and then they creeped up and got a little bit better, and lenders were repricing for the better throughout the day. So we knew that rate hike was coming. Like that's been priced in. That had we'll get into more like the press conference stuff, but we actually saw more. While he was very hawkish in that, he made some points that the interest rate markets really like. So really, the Fed rate doesn't do anything because we're already planning on it. It's like what the data that feeds the Fed was what really moves the market. Yeah.
And, again, I don't want to spoil it, but we're going to get into some of those things that will absolutely impact mortgage interest rates in just a second. So the next thing that the Fed has made very, very clear is that their goal is to, in fact, what I wrote down is to slow the economy and to raise unemployment. And the reason they're doing that is to fight inflation. That's what they're doing. They're slowing everything down to fight this high inflation, to make things more affordable. And oh, by the way, it is working. It's working. And so it's working means, like I was saying at the beginning of the show, it's working from the standpoint of what they're trying to do, but it's wreaking havoc on the economy. So it's like that chicken or the egg conversation. Mm-hmm. They talked about the next meeting on February 1st, right? And so the question is, will they raise another 50 or will they go 25? Do you have a thought on that?
I think it'll be depending on the data, right? That's what he says too, But I do think that we are going to see them go with 25 basis point hikes. They mentioned getting up to 5.1% was kind
That's
of
right.
the overall. I don't know. I can't think of the word right now. Just kind of everybody's general overall consensus of where rates need to be. So it's a question of how high and how long, and they've kind of answered how high, right? And rates today, essentially, with their last move, are 4.25. And so I think that one of the things they're doing is the 0.75% rate hikes and going up from 0 to 4.25 in 1 year is huge. I mean,
Huge.
that
Yeah.
is like a huge kick. And so it is this, and this is why rates have been reacting so favorably, is now this pivot, right? So we're pivoting from that trend line. So that trend line is starting to kind of level off a little
That's
bit.
right.
So I do think we're going to go that. I think we're going to get a really good PCE number next week, and that's personal consumption expenditure. So that's how much we're spending on our stuff, right? And how people. So that shows confidence and like money going out of personal accounts. That report does not take into account as much the cost of housing, which is what's
Right.
really driving inflation, like rent and all those things. So as we start getting more of that favorable data, because what the Fed has done, the more time we give it, the more it's going to improve the inflation situation and hurt the employment situation.
That's exactly right. And so, with that being said, let me show the audience what Powell had to say about PCE inflation and what that projection looks like.
Oh, you got that?
Okay. So again, going down by 2% to 2025, it's all working. It's all working. And the question is, as their inflation projections continue to manifest, the economy, to your point, is going to get worse in 2023, and unemployment will rise. They said, it's at 3.7% right now. They expect it to be at 4.6%, which, is still a decent job market. However, one of the reporters kind of challenged him yesterday on talking about, is a recession coming? I mean, certainly all the signs support that a recession is on its way, but he kind of fought that a bit, and I'll show that clip in just a second. But what are your thoughts? I mean, all the signs that we have, all the data that we have suggests that a recession is inevitable. Do you see anything differently right now?
No. I mean, so the question they're asking him a lot, is do you still predict that we're going to have a soft landing?
Right.
Can we, how bad, like there's a recession coming, like how bad will it be? And listen, when you're the guy responsible for single-handedly like smashing an economy, you're not going to be like, that's what I'm doing. Because
Yeah.
the whole idea with the Fed is to control inflation and control employment, keep them in balance and not goof it up. Then you have all these Fed members who 8 or 9 months ago or 12 months ago are saying, oh, inflation's transitory. And all of a sudden they find out that it's really actually locked in pretty bad. And so no one's going to come out and admit it. Be like, we're going to put you guys into recession. There's absolutely, I mean, from a technical perspective, recession's already happening.
Yeah.
And the one thing that they're really putting a lot of weight on right now, as far as what's keeping us out of the recession, is the labor market. And what they're using that BLS jobs report. Again, this is a government sponsored number that the government is reporting, and it is so highly manipulated, and there's so much variation in the way that they survey these figures. Like if you think about it, so last month they're talking about the 263,000 jobs, and the reason the markets at first, the interest rate markets, didn't really saw that unfavorably. And then they dug into the meat and potatoes of the report, and you're finding out that 178,000 of those jobs were people taking second and third jobs. Actually, employment growth it's already happening there, but it has to do with the way you can post available jobs in multiple places. Like they're just highly manipulated numbers,
Yeah.
So as these things will start to trickle down again, employment is the very last indicator that a recession is happening. And he's basing his forward projections on rates on this the most lagging indicator, right? Like
Yeah.
it just is. I'm trying to think of a good analogy off the top of my head. I'm like thinking about a train driving in a storm and the caboose being dry. I don't know, but either way, like he's there's definitely some missed you would think that he's missing an opportunity. And again, I think that's why we're now seeing them starting to taper. Going back to that comment, they're going to start to change the direction of raising those rates by going to 25 basis point hikes.
Yeah, I agree. I think that next year they probably, to get to 5.1, what is that, 3/4 of a point off from now? So they raise 3 times next year, and they do a 1/4 point every time. So the thing is, with a recession, and to your point, unemployment being one of those key metrics, and he said it was going to. So it's not an if, it's just how high will unemployment get. We're at 3.7 now. If it goes to 4.6, this is yet again just another thing that drives mortgage interest rates down, right? So when we get these unemployment reports, the thing is that people that don't understand this is that as unemployment gets worse and the number goes up, mortgage rates will go down. Is that exactly right?
Absolutely.
Yeah.
And when it comes to housing, right? And we go back to that housing crash. If you think about it, going from 3.7 to 4.6% as a regular person on the street is not going to be something where you're driving around, you're like, man, we're in recession town.
Right.
Traffic lights, there's nobody there. Like it's really, for the average person, is not even going to be noticeable, right?
Yeah.
If you start to think back to the housing market, you go like, man, we're still in this supply shortage.
Absolutely.
The majority of jobs, people are still working because it's services, right? Like we don't manufacture goods anymore. Like very few of it's all services. And that service sector of the employment market is still the strongest, highest paying sector. And so in my head, I'm always thinking, I'm like, and especially now, like planning for next year, it's like, man, we're going to continue to see rates come down. There's so many savvy consumers that were like, I wanted to move, but the prices were too high. And then I waited too long and rates went up that, I think we're going to see a pretty interesting response in the housing market over this coming summer and the next, 6 to 18 months of kind of more of that pent up supply. And we're going to get a little bit more rate cooperation with it.
Yeah.
And that unemployment number is not going to beat us up too bad.
Yeah. And, I guess that's a good place to segue as to like what the landscape of the housing market would look like next year. If we land somewhere around 5 million transactions and we hover around, call it 5.5% on mortgage interest rates, and which drives some more demand with still a housing shortage, honestly, I think it's going to be a really good market for most. We're talking about real estate professionals. It'll be a nice, what I call normal market. If you're working with a buyer, you can get them a great property. You might even be able to negotiate on price a little bit. You probably won't have to compete with 47 other offers. Your buyer will get a mid-5s interest rate, so affordability will be helpful. Prices might even come down 5 or 10%. So I think it'll be interesting nonetheless. But I think the landscape of selling real estate in 2023 or being a mortgage professional in 2023, I can make the argument it will be better than the last 3 months of 2022 has been. You think that, or do you think
disagree
you
with you at all? No.
Yeah, because it's been challenging. The most challenging time was the second half of 2022 for everybody in the industry. Yeah.
Yeah. And it's almost like it's the intersection of rates coming down, right? Some, and I'm not saying like rates are like 3%, but
no,
rates
5.5, 5.75. Yeah.
For people who are watching, there's a lot of people on the fence. Like I've got a whole slew of approved buyers on the fence, right? That were like rate price, that are going back and forth. So going back to kind of the Fed speak, that it's like, it's going to be like a nice soft landing back to normalcy, and anybody in this industry has to know that, the boom and bust cycle, it's manufactured by the people that control the money, that controls the market and this kind of thing. But I agree with you 100%. I think that, I think next year will look a lot different, even though a lot of people are saying, like, even though transactions are still going to be down, year over year, you're going to look at it and it's going to be a lot better.
Yeah. And not to mention, most are calling for probably, I don't know, somewhere around 200,000 realtors to be out of the business next year. So, as transactions go down by 20% or something, and you have 20% of the agents getting out of the business, the ones that are in it, maybe they don't feel a 20% decrease in sales volume, the way they would with 1.7 million realtors if there's only 1.3. That plays a huge part in it as well.
Plus, you got some battle scars. You
Yeah.
learn some lessons making it through that. Like going forward should make you better.
I'm calling next year a professionals market. That's what
Yeah.
I'm calling 2023. It's where the real mortgage bankers will probably grow their business. It's where the real estate agents that treat this like a profession will probably grow market share, because little cousin Johnny that gets his real estate license on a weekend, those people are going to just get out. A lot of them, it happens all the time. As the real estate market gets great, you got every Tom, Dick, and Harry that gets their license because they want a quick cash grab. They can sell a couple houses. But in a market that's more challenging, they don't mess around with the industry. They get out. They go away just the same way these discount companies are. Compass is challenging. They might not even make it. All these iBuyer companies going out of business left and right, shutting it down. Zillow shutting down their iBuyer, Redfin shutting down their iBuyer. All those type of models in a more challenging market go away the same way the part-time amateur mortgage person that does it part-time, who's a full-time teacher, they're all gone.
Yeah. I think it'll be interesting. It'll be it's good for the consumer too. Getting back to having
much better. It's
like
a professionals market.
Professional, exactly, 100%. I used to work in this pressure cooker sales environment.
Yeah.
And rates would go up, and you'd start seeing people sell more arms and stuff, and he'd be like, "Now we're gonna see who can sell."
Yeah.
He loved that environment, So it does. You're 100% right.
So let's go grab some chicken salads. We appreciate you guys. We'll see you guys next week for another update. Frosty, appreciate your commentary like always.
All right, man. See ya. Thanks.